Okay, welcome everyone to the Ultimate FinTech Liquidity Panel 2020, covering the 2021 subjects as well as 2020. So my name is Hormoz Faryar. Today we're going to go through the liquidity matters. We got three big banks on the panel today, and we got Drew. So I'm going to let them introduce themselves briefly. If I may start with Ozgun, please, and then Ian.
Sure. Thanks, Hormoz. My name is Ozgun Unal. I work for a UBS investment bank. I head the EFX sales team in the UK. I've been at UBS for 10 years, but I've been working in this industry in a similar capacity for nearly 20 years. I know that today's topic is around more, our audience is more, retail clients or, intermediaries who service retail clients or high net worth individuals. So for the purposes of this audience, they might not know exactly what we do, how our involvement is in the FX market. So we are a liquidity provider for FX. And we are a market maker in the sense that we make markets, we provide this liquidity to our clients. They then either trade on this liquidity or pass it to their end clients. And how we actually run our business is pretty much getting, flow back, trades back from our clients, and we risk manage that. And that's how we, how we make our, our P&L, our involvement in the market is that. So we are the tier one. We are at the top of the pyramid, if you will, where it goes down through the layers to the market and so on to the end client. And that's and when I talk about liquidity, I'm going to be talking from that perspective and not from a redistribution or consuming perspective. Thank you.
Yeah. Sorry, I think you went on mute there, Ian.
Hey, Ian Daniels. I'm head of EFX distribution for Nomura. I cover EMEA and the Americas. Joined Nomura in 2018. I'm based in London. Thanks for the intro, Ozgun. Effectively, Nomura sits in the same place, as UBS in this tiering. I'm based in London and responsible for managing the top tier FX distribution of the firm's FX emerging market businesses, as I said, for EMEA and Americas. I've been in the industry about 20 years as well. My main roles are to collaborate with sales, trading, technology at Nomura to enhance our product offering, as well as working closely on our EFX distribution strategy. For those who don't know Nomura, we're a sort of global financial services group spanning across the globe. We kind of aim to bring the east to the west, so we're connecting markets across the east and west, and we're trying to give unparalleled access to and from and within Asia. That's our focus.
The big Japanese bank, as it's known as well.
Indeed.
Okay, Conor?
Yeah, sure, thanks. Sure, so my name is Conor Daly. I'm the EMEA head of EFX distribution at Goldman Sachs. I think Ozgun did a fantastic job of outlining our place in the market. We'd consider ourselves as well a tier one FX and EM market maker. The team I manage is 10 people in London, looking after institutional and corporate clients across all of their liquidity requirements in cash and derivatives products, as well as selling access to our suite of risk analytics and software tools as well.
Great, Drew.
My name is Drew Neve. I'm currently the CEO of Trader Tools, which is a software vendor primarily for banks for aggregation, distribution of liquidity. And, we are about to introduce a market making product for regional banks. Previously, I was the co-founder and CEO of FXCM, and I co-founded FastMatch as well. As FXCM was one of the largest at the time retail brokers in the world, and had a pretty big institutional business as well. So I know the market from many different angles. And that's, I can talk about it from pretty much everywhere.
Yeah, that's great. Thanks, Drew. Okay, so I just wanted to go through briefly, since we everything's moving online in 2020 and everyone's talking about that. I just wanted to hear from the bank's perspective. Are there kind of more initiatives than ever before at the banks? Has it accelerated now, or is it just the same? NDF swaps, etc. What do you guys see at the banks in terms of initiatives? That's a very quick one on this one, and then we'll move on to the next subject.
Am I going ahead with that?
Yeah, you go ahead.
Sorry.
with this one. Yeah.
Okay, sure. So to be honest with you, everything moving online, I think our shopping has moved online. I'm no longer going to a butcher and buying, from a shop, but I actually am getting it delivered online. That's the only thing that moves online, because in our world, in the FX world, everything was online already, and all the initiatives were already in place, or everything that we planned to do are happening.
Except our meetings. I guess our meetings weren't on.
Yeah, absolutely, and our meetings, exactly. I haven't seen any of my clients actually since March, which is very, very painful in itself, unfortunately. But from a business perspective, everything just goes on as planned, as we had it in our roadmaps. If I'm talking about our bank specifically, what we really focused this year was actually ENDFs. That was, EM was our main focus in general. We've gone quite a long way with the deliverable side of things, but NDFs were where we needed more investment, and we've been doing that for the last couple of years. And we actually the impact of that, obviously volatility, and the fact that our clients moved to working from home environment, and trading moving from voice to more electronic means, has actually improved liquidity in emerging markets, in my opinion. And we've done quite well in the ENDF space, and it's still an ongoing obviously a journey for us. It's not the end. And the other thing, I guess, was quite crucial for us was we've been increasing our liquidity in FX space since mid 2019, and we kept increasing that. I know that, again, for the high net worth and for the retail, or for the retail aggregators, this is not really a major concern, because I think they can access the liquidity that they need even in these markets. But for more of our institutional clients, like hedge funds and real money, this has been an enhancement for them. So from that perspective, again, we focus very much on that, and in other products as well. So again, another initiative for us was Easter. We've been electronifying our store franchise for a while as well, and again, it came in quite handy when all these things actually with the volatility increasing at especially in March, when we found ourselves in that situation. The fact that we've invested in all of these initiatives actually paid for itself, by providing stable pricing, consistent pricing, and providing a price at all the times where we had these liquidity issues.
Yeah, Ian, if we take a look at ENDFs, non-deliverable forwards, for most of the guys, what is the biggest NDFs? It's INR, Brazilian.
Yeah, I think interesting what Ozgun said. I think it's a similar thing that plays out, and certainly something we've seen in the industry surveys we've been looking at, and which we take part in terms of the electronification of the non-deliverable forward market. I think the most liquid are really, our focus is on Asia NDFs, the most liquid being INR, Korea, I guess Taiwan and Brazil, from the LATAM side. And I think for us, it's a key initiative. Nomura is known as having a lot of risk in the game when it comes to NDFs, and I think we historically have not had the electronic product, and we've been playing catch up. But that's something that's been a key focus for us, and we've noticed as well that generally in the market, and as Ozgun mentioned, in terms of the working from home environment, it's pushed more and more things electronically. I think the initiatives, and I think you mentioned earlier, like what what's different. I guess, you know, it's a constant rollout of the initiatives for all the major players. The electronification of everything, I think, is the key thing, right? There's, you know, wherever there's a product, you're going to look to electronify it because you want to ultimately save costs. And then what has happened with working from home, I think that's pushed something that perhaps was going to happen and was happening. It's just accelerated that. If you look at the option space as well, the notionals traded have increased, you know, 50s and 100s in face value of the notional for 50 and 100 million for the audience. So the face value of the notional is sort of nothing out of the ordinary. And I think the additional deal types that are being added and the more structures that are being put in play. So I think it's you know, these more, perhaps not, should we call them, for want of a better word, non-spot FX products that have been seen a lot of focus this year and will see focus next year. You know, many talked about quite a lot in terms of the swap space at a short-term interest rate arena. The electronification of that piece as well, again, for us is another major thing. You know, something we have been looking at over the past year and hope next year will be where we can, you know, start to compete a lot more. I think that is somewhere that actually, ironically, in the sort of client space is very electronic, but is very heavily in the interbank space is very much still a broker market, and that's something that we feel it'd be quite interesting to see how that plays out. But yeah, I think in summary, it's really the focus, I believe, and this year and for the coming period will be those non-spot products that to a certain degree are electronified, but you know, there is room to grow.
So anything electronic? How about, does that include Bitcoin, by the way?
Well, you would imagine, you know, Bitcoin comes from an electronic, is effectively the ultimate electronic product.
But
right?
you won't trade it electronically. It comes from there, but you won't trade it electronically. Yeah. No, yeah. But banks are quite, you know, this mixed bag on that Bitcoin story, right?
Yeah, I think it's, you know, I think there's room to grow there. Again, like I said, the sort of non-spot, I mean, that is, I guess, a spot product, but you know, these sort of, for want of a better word, esoteric products, there's always an opportunity. You know, I think, as you've noticed, you notice that a lot of when I read a lot of articles at the moment, it's around how banks are looking at this, and you know, quite rightly, people are going to be, you know, perhaps a bit conservative on this. You know, as a bank, you have certain, you know, certain rules that you're adhering to. You have the rules to your shareholders, etc., etc. So you know, you can't have you have to have a certain risk-based attitude looking at these things, and you have to weigh up the pros and cons, and perhaps more conservative manner than perhaps some other players. But I do think when the time is right, then you'll see banks enter the fray.
Yeah, Drew, before I move on to Conor, Drew, on this one as well, initiatives, and you see, I mean, that plays into your hands in terms of the more the better, the more products, right? Pretty simply.
Yeah, and I think that, I mean, we, for example, Trader Tools specialize, a lot of what we do is emerging markets currencies. And it's really where we see, like, so we see a lot of different clients, be it regional banks or brokers. So, and I obviously viewing it before even at FXCM, you look at it from like market share in G7 currencies by providers have been pretty steady. The biggest providers have been gaining market share the last 10 years, yes, but kind of steadily. But generally speaking, market share has been pretty steady in G7 currencies. You're not going to see a lot of surprises. Number one liquidity provider this year is going to be your number one next year. But you know, where usually things shift around a lot is EM currencies, right? And you know, things where still there isn't this concrete dominant players, right, in those currencies. And I think that's what you're seeing is there's room for, you know, new people to enter that market and really make a difference, because while, you know, like a lot of brokers would have 20 providers, you know, streaming them euro is just completely unnecessary, because, you know, they can do that with 4. In emerging market currencies is where there's a big hole, and if you depend on very few providers, I think you're in deep trouble, because there is an inconsistent, still, you know, an inconsistent feel to it, and the market's more challenging. And so I think this, if you look at where the big opportunities are, right, for providers and for brokers, it's in emerging markets.
Yeah. Okay. Conor, from a Goldman's perspective.
Yeah. No, look, I'm glad that you asked around EM markets, and I agree with Drew. This is a space where there is opportunity for other players. I would just observe, however, that there are some banks already from a lot of the consultancy work that we undertake, and also I suspect the surveys that Ian referenced earlier, which suggests actually there are banks making much more significant forward strides in adding electronic workflows to things like NDF trading and to algorithmic risk management in the price production. We know, for example, that Goldman Sachs trades 3 times as many NDFs in dollar volumes per year as the next liquidity provider in the market. So I think, to Drew's point around there being there being a need to go to kind of a larger group of names, I think it's more important to engage with providers who are stepping up with the technological investment and with, importantly, in NDF markets, as we've seen this year, particularly in areas like like in Brazil, particularly with all of the kind of domestic COVID issues that they've experienced, have also the risk appetite. Okay, this is something that really differentiates these markets away from G7 markets, where price discovery is very good and volatility is so much lower. So GS has been working on algorithmically risk managing more and more of these products, much more over the past couple of years, and that's put us in the market share position that we're in today. We were also the first bank to release an external liquidity seeking execution algorithm to the market as well. So this is providing access to our institutional and corporate clients with a interbank field product in the same way that they can that they're used to in listed markets, splicing up orders and getting the best liquidity from a fragmented marketplace, being able to do that in the NDF space. And the uptake that we've seen this year, both from the institutional space, but also I'd say, interestingly, from broker dealers who want to white label this product onto their own clients, has been very interesting, and that's an active conversation that we have with a few clients. I think on the second market, Hormoz, that you touched on, much unloved FX swaps, particularly for kind of retail investors and for broker dealers. This is a market that really has hasn't got the innovation, hasn't got the technological spend in recent years that we've seen in the One Delta product. That was something that we really tried to address this year. There were 2 big releases that clients will have seen in the public press this year that Goldman Sachs made. The first was to launch a commingled risk management of all of our FX forwards products out to 5 years. So what we mean by that is we actually have 2 desks, just like Ozgun at UBS and Ian at Nomura, both market making manually a front-end rates curve, as well as a team managing black box risk management in that product. So what we're able to deliver then to our clients is a bid offer which delivers the best of both of those desks, which is a really interesting value proposition, we think. The second item in swaps as well was our AX monitor. So here, to Ian's point, which I completely agree with, that you still have this kind of almost absurdly over voice-driven interbank broker market for some of the swaps activity. We've migrated all of the AX activity, all of the interest that we were showing in that market, which is a very expensive place for large banks to deal in, directly on our screens, and distributed that product out to regional banks. And there we've been able to deliver material cost savings to the market, both to regional banks, but also to large broker dealers who have to roll all of their open positions on a daily basis. And the fact then that we can reduce their financing costs, and they can either choose to take that as bottom line P&L, or to add an element of competition and differentiation in terms of the financing product that they provide to their downstream retail investors, has been really interesting.
Yeah, I mean, that's great with the forwards and swaps. I mean, I wish Goldman's could do ramp up the PB business a little bit. That would have been excellent for brokers out there. I don't know about the FX PB, still not one of the main things you guys do for, right? That's pretty much on the back burner, the FX PB, right?
Yeah, it's a very limited offering that we have at the minute, I'll be honest. and probably something I would suspect in 2021. It's unlikely that we're going to materially expand. However, we are having extensive conversations with the broker-dealer community about being an FCM, on listed contracts, on being an XTPB as they want to get into CFD products and things like this. So, the door is not closed. It's just we want to, provide a quality service where we think we can actually differentiate.
So I wanted to ask something about volatility, but before I do that, I'm going to jump to Drew and ask something that came up this week and last week. Some brokers were fighting over this RTS 28 reporting. Drew, there was a big fight between some brokers out there saying, how do you report this? Are you booking trades? Are you market making? Are you saying you're not, but you do? Just wanted to clarify that a little bit. If you could explain the situation, Drew, a little bit on this RTS 28. I'm assuming it doesn't impact the banks as much, clearly. They report it differently.
So I think a lot of this is, US regulators started this in 2016, and now obviously it's in Europe, and you probably migrate, over, in other markets as well, to basically for brokers to report who they execute with, right? And have to name names, for.
Isn't that a bit unfair to even name who you execute against? The whole concept is isn't that a bit weird itself, to say where you're buying from, essentially, kind of like show me your suppliers, essentially?
To try to make sense of government regulation, I always thought was, completely ridiculous. But like it's one of those things that, these regulations are done mostly for virtue signaling purposes, right? To tell people, oh, you see, it's a market is, we're providing transparency. And to a degree, transparency is good, right? And I think it's from a trade reporting perspective, there are a lot of trust issues in the retail FX industry, right? And there is like enormous amount of trust issues by clients and by counterparts. And I think it's an industry that should err on more transparency, the better, right? And, it is not so simple sometimes, because different people, as you had to fight because different brokers interpreted the rules a little differently, and everybody, technically could have the correct interpretation, but obviously, from a spirit of the rules, as of what the industry needs more transparency, not less, simply because just like the institutional FX market, right? It's marred by, enormous amount of mistrust by clients. If you look at institutional clients, majority of them just don't trust the people they deal with innately. And that's not just an FX thing, right? That's across all capital markets. Capital markets has a bad reputation, right? Financial services have a bad reputation. So I think that is just one of those things that.
Yeah, I think the RTS 28.
This is essentially, these are really reactions to it, and I don't think are they that useful for the client? To know that this trade went to Goldman Sachs and that trade went to UBS, it matters more. Did he get the price that he wanted, and didn't get slippage and that type of stuff? But the reality is that, who cares who was the counterparty, right? In real essence, but the transparency is actually extremely important for trust building. It's just a question. The problem in FX is that you have an issue that it's a global industry, lots of different jurisdictions, many different rules, very hard to create that common thread of, level playing field. Everybody's playing in the same.
Yeah, I think one of the things with the regulation thing was also the jurisdictions, right? Where people said, look, you're saying I'm sending out all the flow to external source, right? I'm taking a price. I don't book anything or take risk. But then you're sending it to an entity of yours in some other jurisdiction that is yours 100%, and you guys control it. And you are doing market making and risk taking on. So on the RTS 28 report, you're showing that I don't take risk, but you are. So that's the tricky part, I think, where some people are saying, look, just say it as it is. We do take risk over here instead of here. And that's where I think the fight was a little bit simplistically. Okay, so we'll
Yeah, and
clarify.
I think, look, unfortunately, right, you're going to have many different practices, but I will say on the bright side to all of this, you know, retail primarily trades fairly liquid instruments, right, for the most part. And there is enormous amount of price transparency on the internet. There's enormous amount of competition, right? And I think what you're going to see, and this is obviously in institutional business the same, right? And all the, you know, people, you know, saying, oh, well, I've got this measurement tool and all that stuff. At the end of the day, really, you know, you have enormous amount of choices as an end user, consumer, retail wise, as a broker, as hedge fund, whatever. And you can go to lots of different people, and you know, you can choose if you don't get your execution, you know, from one as good as you want it for one provider, you can go to the other. And I think there is so much competition out there that I think what you'll find, especially over the last, you know, like 10, 15 years, is that standards have gone up everywhere, right? So even people who are booking trades, right, have the fills that they have had to give, right, for the most part. And you put aside those brokers that serve total amateurs and charge them very wide spreads because they're basically really, it's an onboarding you know, game, and there's a few brokers that do that very successfully. Their execution doesn't matter. But if you look at all the big brokers in FX as an example, and you can see that with banks too, right? Competition has forced standards to be so high. The differences between people is shrinking, right? And I think that what you're seeing, and that's what I was kind of getting to in the beginning, that in the most liquid instruments, the differences are not there. Like if you look at EM, there's still, you know, very big differences between banks, right? Different times, different instruments, different levels of volatility. You'll see lots of different things. But I think that if you looked at, you know, competition in Euro has been so heated so standard for such a long time, right? That, you know, the standards in it are very high. So I think that, you know, if you ask me, do you need the reg from a technical perspective? I think the regs are useless, right? They're just more bureaucracy and more compliance officers, and they're utterly unnecessary. But optically, the industry does need it, right? Even though I think a lot of its problems are in its past, not in its present and its future, right? And I think that that's you know, something that you know, is not the case, right? It used to be, if you looked at 15, 20 years ago, a lot of players in the institutional business and in the retail business played games with the rates all the time. Right?
Yeah, I have a feeling like the
regulation can't play games now. The prices are too competitive.
Yeah, reg looks difficult, but at the same time, I'm sure it has some benefits in the background, brings focus, etc. I just wanted to know, just quickly, banks don't have to do this kind of reporting, right? Where you have to reveal on a website to everyone how much you internalize, right? Am I assuming, for example, Conor, you guys don't have to report how much you internalize, right? To all of us out there.
We do have our own form of the RTS 28 report. I mean, everything is publicly available on the website. If you really want to read the report, you can see exactly what's there. But there is a you know, a format to that, yeah, that we're bound by as well.
Okay, cool. Volatility, quarter-on-quarter volatility, and the impact on the volumes. Can someone quickly tell me, like, it was a big jump in the second quarter, right, Ozgun? It was like, was it first quarter was bad, and then what happened?
Yeah, so for us this year has been obviously a great year, but not just because of the March volatility. Yeah, of course, March was very volatile, and you know, our business thrives on volatility. Volatility means more people are, you know, trading, more volumes as a result. We started the year actually quite well. Again, because of all the things that we've done, prior to the year, we were in a very, very good place, I guess, for this volatility. January was fine. Obviously February, we've seen towards the end of February, we've seen a spike in volatility, and then March was madness for, I think, the street, all of us. Record volumes for, I guess, all the venues, all the banks. That's undoubtedly has been the case. And it came with a dip in April, simply because the things, we understood where we were. Everybody mobilized obviously in March as well, right? I think after that, move to working from home and understanding that everything works, no need to panic, we can still risk manage, we can still trade, all the systems work, etc. With obviously understanding what COVID was and how it was going to be tackled. I think April we saw a dip in volumes, and also a lot of people actually has either digested their risk, or they close their positions, or etc. After that, actually, April was the month where we saw the dip at UBS. From April on, it's been actually a quite nice upwards ride. Again, it's just it shows that the systems that we put in place, the robust pricing engine that we have, the scalability of our business. I mean, we kept pricing through the entire month of March, and I'm not talking just about spot. I'm talking about stir, NDFs, options. We were streaming where liquidity was scarce at times in certain products. So for us, it's having that core infrastructure actually was the main event, I guess. Volatility comes and goes, right? It's like we had flash crashes before, we had SMB years ago. It just comes and goes. You need to actually have a business that could service your client base in market dislocations and under normal circumstances. So it's having that franchise, I think is quite key to be able to survive market conditions like this. And yes, today, I mean, this year has been a great year. COVID related, market related, of course. And I think, for the industry, from that, from another, side, it's been great. I think the industry has mobilized themselves so well. And, we were working from home within a week of, us mobilizing, technology worked incredibly well, I would have to say. It shows, I mean, I'm still working from home, and I can do whatever I can in the office from home. So I think it's also, we need to recognize that this situation actually will change how we work in the future as well. But from an execution or providing liquidity perspective, COVID had no, let's say, significance to how we would be doing business, under another circumstance or another flash crash, etc.
Ian, how about you guys?
Yeah, I think, to be honest, similar things. I think that's I think one thing we need to, looking at maybe taking a step back and looking at the wider world, I think the positive thing that's come out of these difficult times has been, from our industry perspective, has been, as Ozgun said, the way we managed the crisis, and the way, from a business perspective, that we've been very busy. I always think, if we, the days when we're very, very busy and loads of different things happening, you're trying to manage everything, and you're sort of like, oh my goodness, what am I going to do? You take a step back and think, wow, we're lucky, right? And we're lucky that we're in this industry, and we're able to get that chance. There are people out there who are in a lot worse positions. So I think we need to, firstly, I'd like to say that I think we should, we need to be cognizant of how lucky we are. And I think from a Nomura perspective, it's been similar, very, very, elevated. You can see from industry surveys, end of Q1 volumes are up 50-75%. Normalized back in, dipped a lot from that in April as things got back to relative normality, and then kind of, tipped along at semi-normal, but I'd say elevated levels, and from our perspective. And then as we headed towards the US election, then again, another sort of spike of activity. So I think overall, if we look at the 2020, it's going to be seen as a, from the FX industry's perspective, and a lot of equities certainly, it's going to be seen as a very good year. So yeah, it's I think having a diversity of client base as well, again, as if if people are, some clients are perhaps not as active, and then you pick it up with other sets of clients, and that's been the key focus. And a lot of the work you do, I think, has borne out that, to fail to prepare, is to prepare to fail, right? So the preparation piece, we couldn't have foreseen this happening, but the fact you're doing a lot of work with clients and you're pushing forward, back in the days, going to see your clients and getting them preparing for getting them onboarded and ensuring they know what you do as a provider has stood us in good stead. Thankfully, this good vaccine news, I think, is key for the next year. Could prove a more difficult year if we were all stuck at home again. I think I do think the industry performed very well, and overall 2020 from a perspective of performance will be seen as a good year.
Yeah, Drew, what do you think next year is going to be volatility wise? I think 4 months ago when we last spoke, Drew, you said the FX market hasn't been tested. This is nothing big's happened really. Do you think we'll see that? Some big stuff happening
FX
next year?
is always, we're long the misery of other people's markets, right? Of other markets, right? So it's what we need is a solid, sustained, real horrific bear market in equities, and we're good to go. And that's like 2008. 2008 to 2010. It's like the golden age of FX, right? And working for a bank may not have been great at that time because the rest of the bank was going under while FX was making money, so the bonuses weren't great. But working at in a non-bank, right, in FX in 2008, 2010, just was the best time ever, right? And I think the problem is that we have, things because of interest rates, post-financial crisis, really flattened volatility for such a long time, post that super volatile area of the 2008, 2010, that the market's really unprepared for volatility, right? And you can see that with S&B, and there's two real factors that are at play. There's three. One is that participants get normalized to trading lower level volatility. So strategies get optimized, for that. And I think, and especially in retail, that's the case, right? People range trade, but very large majority are range traders, right? Which does not prepare them for volatility at all. I think the second, but the two other factors are, one is regulation. So if you look at regulations have penalized risk taking, and have basically illegalized many forms of risk taking, not just at banks, in a lot of places. And so risk has really, people have taken a lot of risk off the table. So there isn't that super informed better, right? Like, a desk at a bank, right, that would know client flows and can see, okay, there's been an exhaustion in selling, so this selling wave should be over. And now I can go and buy a lot of euros, right? Because the margin calls are done. That informed seller is not allowed to go take positions in the market anymore, right? So the people with the most information, out of this need for fairness, quote unquote, we have said, you're not allowed to gamble anymore, right? But which is good for fairness. But in this quest for fairness, we have basically destroyed market stability, right? Because those are the people who would come in at the worst time and yes, make a lot of money, but they'd stabilize the market. Right? And we don't have that today, right? And today we're chasing any little infraction, any little thing to the nth degree to penalize the people who have made an unfair amount of money, right? And I think that's a big weight structurally on the market. And the third issue for market volatility is really that to compete with HFTs, many banks have turned to HFT technology. Okay. And so a lot of what, we have, like most of the algorithmic trading stuff that banks have, not the algorithmic trading where they're chopping large orders for clients, but the stuff where they're making markets, right, looks more and more and more like an HFT, right? From speed, from how fast they update, what they do, how much risk they're allowed to take, right? And you're going to see a lot more, like, again, so all of this is connected together. I think the market, and this is not just an FX issue, is less and less prepared, for large, real cataclysmic events that were more financial in nature than COVID. COVID was more of a human tragedy than it is a financial tragedy. When we get into real financial tragedies, I think market's going to be tested. And I think the real lesson for clients is there is no mechanism out there to save you. And we just perpetuate, you have to take less risk because you have to be prepared. Then you can't really depend on many people when, the shit hits the proverbial fan, right? And I think that's the problem, right? And because that only gets the market even more so looking like that. And I think that's something that has gotten worse over the last 10 years and is getting worse still, right?
Yeah.
And and that's something that I think is unfortunate. But you have to basically plan around it, and have lots of contingencies and do lots of things. But we are less ready as an industry. We are less and less ready for emergencies every year.
And Conor, in terms of both this volatility story and also the fact that the market, everyone says market is fragmented, just to define that as well. What do we mean? Like spreads are better for smaller tickets, big stuff is still expensive. Is it more expensive than, like, a big ticket is more expensive than 10 years ago? Or we should expect it to be much better now? Or is it not? Or has nothing moved on when it comes to big tickets of 100 million plus in spread, for example? Has everything just meant that everything in tiny tickets are amazingly fast and competitive?
Yeah, look, it's a good question, good few questions, I think. It's certainly the case that these markets don't all exhibit the same linear extrapolation of cost of trading through notional sizes as each other. That's absolutely the case. But and actually, I wanted to pick up on one thing that Drew said, and I agreed with a lot of what he said around sort of opportunity relating to volatility, and particularly with the collapse of interest rate differentials as global central banks have been so successful in taming inflation, particularly since sort of 2014. But I do take issue with the point that bank market making looks more like an HFT these days. And I think the important behavioral characteristic that I would flag, which tells me that this is true, is for all the panel can sit here and discuss that this year has seen us work from home and having to do a few too many Zoom quizzes that we don't want to do. In March and April, we actually saw a relative increase in the percentage of our voice trading activity. And that's because, exactly the markets that Drew is outlining, what people wanted was they wanted, yes, the reliability of being able to transact, on a firm risk price on our single dealer platform, but they also wanted to be connected with risk takers directly on the trading floor, knowing that they could ask a risk transfer price in their size and get done and transfer that liability to the banks. You cannot call an HFT market making desks, right? No one is making that price. No one's picking up the phone. And I think actually I was pretty pleased with actually how robust those markets were in March and April off the back of that delivery of service. And that is something that banks will continue to do. And the banks that stay in the market and offer that service will continue to differentiate that. On the on the point around sort of fragmentation of the market, the question around, is the spread in 200 cable the same as it was 10 years ago? I wouldn't like to make either price personally at the minute. I think it's certainly true that in FX markets, one thing that we've noticed this year relating to kind of levels of turnover and whether market activity is always directly linked to volatility is, you can have too much of a good thing as well, I think, in volatility, right? There's two markets, particularly in the last few years, that anyone listening to this panel today will have been active in, which is Turkey spot, which has historically been a very large retail FX market to operate in, and also sterling. And this year, both have seen very high levels of implied FX volatility at times, but actually cash activity has been heavily depressed. And their pockets in our franchise, really, which normally would contribute very large percentage, shares to our market share, that we've just seen clients excluded from, because the cost to transact, even with a high quality market makers operating in that space in the interbank market, has just rendered them untradeable. So I think it is important to balance out that sort of thirst for volatility constantly with the need to actually be able to understand what you're doing, to speak to risk takers who can help you, and also the ability to transact. And that won't always be electronic in small tiny tickets.
Okay, anything to add to that, Ozgun? I guess some algos come into that as well.
Well, I mean, look, I completely agree with you, Conor. Having a traditional voice desk in these volatile markets is a key, I think, to continue providing a service to our clients. Let's face it, our client base doesn't just consist of retail clients or high net worth individuals or broker dealers that trade small sizes. We have quite a big franchise in hedge funds, real money, and corporates, financial institutions, and banks, right? And they need that service in these volatile times. And again, just like when we had this panel in 2008 and 18, and we talked about the SMB, the impact of SMB, and how we were able to service our clients, this was no different. When people need to trade as a market maker, we need to provide it somehow. And if it's not electronic, which it was, by the way, we didn't have any issues with liquidity. And again, this is G7 I'm talking about, and maybe sterling is not a great example for the purposes of this question, because we all know what's going on with Brexit and the liquidity constraints with sterling at the moment. But yeah, completely agree. You need to support the business. It's not just about electronic business. It needs to go hand in hand. I mean, FX algos, yes, absolutely. We had a stellar year with our FX algo business too, and where our clients required that anonymity to execute the large tickets and wanted to access the street, the liquidity of the street, we were able to provide them this service. But I have to say, I mean, our principal business still, EFX principal business, has been at the core of our liquidity provision. And in terms of the market fragmentation, I mean, to be honest with you, I think the FX market is fragmented, yes. And is it increasing? Maybe a little bit more so, because we have so many intermediaries actually entering the market. And we clearly are providing liquidity, and that liquidity gets redistributed and gets diluted further, right, through this chain. What I will say is I want to flip the coin a little bit there. Yes, there are quite a lot of intermediaries out there, but for a retail client, how do they define who do they trade with and who do they go to? Is it just spread that they're looking at the retail clients? Maybe to our audience, what I can say, again, being a tier 1 liquidity provider and not knowing the intermediary market inside out, I would say, look, your brokers, your intermediaries, ultimately are getting the liquidity from tier 1 banks, either directly or indirectly. Somehow you're trading with us at the end of the day through that chain. So to this day, I'm seeing flow from 5 different clients coming at the same time, for a same trade, and still we're dealing with that. Now, in order for a retail client or a smaller hedge fund where they don't maybe have access to credit to face a tier 1 bank, and if you need to go through a broker dealer, don't trade with 5 brokers. Don't have accounts with 5 brokers, because ultimately you're just you're just basically contributing that fragmentation of the market, and you're going to be suffering as a result, because you're not going to get the best service from that those 5 brokers. You're not going to be a meaningful client to one of them, but you're going to be an average client to 5 of them, and your pricing will get affected as a result, because you're just distributing your flow, which might be a great flow, to 5 different people who are ending up trading with the same bank ultimately. So I think we need to look at it from that perspective as well. And as much as we tier 1 banks would like to service all of our clients to the best of our ability, and we do so because we also have the analytics to be able to do that, but I would like to toss it, have a think about how you're impacting, because if each client thinks and says, why am I trading with this broker? What add value they're giving me apart from spreads? I think that's the key. Are they looking at their reject ratios, round trip turn times, market impact? All of those, I think, we can't just talk about spreads, I think, in this context. There's quite a lot of other factors to think about.
You could flip that as well and say, okay, then maybe there is, all the market making's happening at too few banks as well, per currency pair. So some people in the market, I don't know, what do you think, Drew, may say, okay, you know what, maybe we need more banks who are genuine market makers within specific currency pairs, so that, everyone's, maybe people are looking, we've noticed this year that some people are looking for more liquidity providers. So they weren't perhaps happy with certain banks or non-banks, right, Drew?
Yeah, so I would say, Ozgun is right to a degree that there is a lot of brokers really misusing this. They're an average client to 10 counterparties instead of being a really good client to 3 or 4. That's probably one of the biggest mistakes in the industry, right? And I raise my hand as the guy who made the same, right? And it takes a while to do. But on the other hand, there is an enormous amount of concentration and market making. And, that is very unhealthy for the market, because there's a lot of variables so brokers have to worry about: headline risk and banks cutting them off from compliance reasons, right, from any time. And banks are more sensitive about these things, right, and terminate faster than they've ever done. When financial pressures really come, banks, we've seen this with PBs in the past, terminate underperforming clients credit-wise, right? Be it because they in the wrong country, like Turkey, right? Or be it because they're in the, that's going through a lot of credit, issue, right? Or they're, in an industry, or they do little volume. So I think there is a lot of stuff, but I think one of the reasons that Trader Tools, a new product we're releasing in the coming few months, is really basically a high frequency trader in a box without the speed, for regional banks to really start taking risk and being real market makers, and actually for brokers too, because I think there is this issue that there is too few real end makers, in the market, and that competition which is, good for people on this panel, I understand, right? But, for the market as a whole, right, it isn't great when there's too little competition. And I think that that's something that is very important. And what we're seeing with a lot of our clients is that what you were talking about before is obviously execution's awesome at that, you do €1 million, you can't ask for better than what we have these days, right? But, when you want to do big tickets and you want to do Scandies and you want to do, Turkish lira, and you want to do those type of things, then things become a lot worse, right? And, there's a lot of issues. And what we have today is the regulators have pushed the industry in the wrong direction. So too many rules limit the amount of players in the market, limit the amount of risk they can take. So all the banks are forced to hedge quicker, take less risk. So those hedges are hitting, I want to say, public markets, as in ECNs and things like that, which then that market data from that ECNs get reported out to everybody, right, who consumes it, who know how to front run the big trades that are coming, and that's why the markouts on these trades turn out to be horrible, right? Because the data leakage, right, from these things become very high, because the regulators have told clients the dealers are bad, go hit, exchanges are better and ECNs are better. That's not true, and the more
well, we don't have an exchange on that
internalization.
panel, but next panel I'll get you an exchange who can talk
Well,
about that
if
as
you
well.
look at
Right,
one
Ian?
of the things, I've done a lot of work on this, like scientifically, we've done a lot of studies on this in FXTM. We do this on Trader Tools too with clients. You can see that basically the more you send orders to people who internalize risk, and in that sense, Conor, you're right, that banks are better than HFTs because they hedge at, they hold risk more, right? Than most HFTs. HFTs are different, right? But I think that you're having this issue that the faster, right, your trade sees the light of day in terms of venues that report market data publicly, the more slippage you have. So I think there is this, issue where there is too little competition, and the rules have pushed us in a very unhealthy way. So we're still fine in euro dollar and dollar yen, and probably even in small sizes in sterling, but when we go to other currencies, we are not, right? When we go to, and that's where I think a lot of what we're planning on doing, to better the experience of our clients, is really go and help them, internalize more, take risk more, and basically, be market makers themselves, go out passively into the market, and really try to, do a little bit more than that, because I think it really depends on what you're doing, right? And when you're doing, again, emerging markets, Scandis, that kind of stuff, things are not as positive as Eurodollar.
Yeah. So, guys, Ian, just last 2 minutes, and then we're running out of time. The Zoom panels, the time goes faster for some reason.
It does. Yeah. I mean, I think just a few things. I think there's a few things that we need to pick up on. I think fragmentation. I think we found that you look at the studies of where although there's a wider market, and look at EBS top of book spreads, they've come in, but the depth is not there. So it's certainly something we've seen, the lack of depth to the market in terms of since March. I think as Ozgun was saying, in terms of selecting your brokers wisely, I think is key. Be that, and that applies at any level of the market, right? And that applies to people who are coming direct to us or a level down through other intermediaries, because whilst I think that it's not great to have a concentration risk. I think that needs to be lessened to a degree, but you shouldn't spread yourself out too thin. As we were alluding to, why do you need 15 people giving you a euro dollar price? Is it going to get you anywhere? Is it going to get you any better liquidity? Probably not. But there's still a need for perhaps niche players, regional specialists in certain pairs, who can then help you drive your business. But I think you just need to be cognizant of who you're dealing with, number one, and sort of how many people you're dealing with to get the best price. And I think to get the best experience, and again, it's not all about spreads. You've got to look at rejects, round trip times. People could give you the best spread, but reject you 50% of the time. What's the opportunity cost for that reject? You could have traded with someone else at a better price, right? So I think that's key. And I think the other thing, looking at, we're talking about how people exiting flow, and we're seeing that a trend has been there's a bit more of in recent times aggressive exiting of flow from certain so-called market makers, and I think that creates a more high volatility and unnecessary, and perhaps can pose some risks. And these type of things were alluded to in the recent BIS surveys, and also they were also talking about the increasing use of algos and how that has its positives and perhaps negatives. And I guess that's another point for another subject, another day. But I think there's a lot of things to focus on here. How you select your liquidity providers, the fragmentation around top of book to the whole market. Going back to your question from before about the spread in cable in 200, and how how people then end liquidity providers do hedge. Are they actually in the end giving you anything if they're just getting out of the flow really quickly? That's just causing more of a market impact and perhaps not adding any value whatsoever. So I think we just need to think about those things. And it's interesting, we've talked about this many times on the panels, and perhaps some people don't think it's important, but I think it's even more important nowadays.
Yeah, that's great. I think we need a real non-virtual panel next year. What do you guys think? Huh?
Let's hope so. Let's hope
Definitely.
Yeah. So thank you everyone for the time. We ran out of time. Unfortunately, I had many more questions, and we have audience who will give us questions. So you can't take it. We'll take it on the real stage next time.
Right.
Hopefully.
Thanks very much.
Thank you. Thank you.
Thank you.
Everyone.
Bye.
Thanks, Hormoz.